Hi guys, welcome back. So what a day today again. Nasdaq made all-time high. In fact, it has been growing every day for 2 weeks, and I think a lot of us would agree and share the same feeling that our portfolio is not benefiting from this at all, if not reaching lower lows. And because a lot of the growth stocks had broken out a lot of supports and would take time to recover. So I think at this point, it's not a bad idea to diversify a little bit. I remember 2 months ago, around the end of January, I had made a video about sector rotation where I talked about how I thought the heated sector, like the EV, the new energy, the biotech, the penny stocks, and the Wall Street bets stocks might be in danger and overvalued. So I said we need to watch out for sector rotation. And I gave an example on how people lose money on the way of a stock running up. They make some profit and then thinking that every stock would be the next BNGO and then end up putting more money in it or going all in until the stock might have a danger of diving one day. So I said we need to watch out for the EV, the SPACs, the biotechs, the penny stocks. And I thought sectors might rotate to airlines and cruise line and possibly MJ2. And in this video, I specifically recommended Mesa Airlines. And at that time, Mesa was $6. And I gave it a price target of $8 to $10 in a short term and $15 in a long term. So we see that it went from 6 all the way to 17 in 1.5 months. And it happened to be a good hedge against our portfolio during the whole market correction this time. So it really doesn't hurt to diversify our portfolio, especially when we know there is sector rotation and the smart money is already getting ready for the next sector. Because right now a lot of the growth stocks are looking very similar. Most of them look like this. This is an example of BNGO, but if you open many of the growth stocks, they will share a similar chart. And this means that we need to give it a lot more time and patience for it to recover. So meanwhile, we can get into diversifying our portfolio now. So if we look at Dow Jones, it has been growing well almost for a few months already because the vaccine is rolling out. A lot of people are expecting a good recovery after the COVID. So a lot of money has been going into a lot of the value stocks in Dow Jones and also the recovery stocks such as airline and cruise lines. So does that mean this is where we should put our money in right now? First of all, I think a lot of the airlines have been growing quite a bit. For American Airlines, you see that it has been growing from 15 to now 22. So 40 to 50% of run up. Right now it's backtesting, consolidating. There is possibility that it can still have room to grow because the capital might be still hyping up this kind of recovery stocks. But at the same time, we also need to watch out for the value traps here and there because it is now about 30% down from the price before COVID. And not only right now, the revenue is nowhere near 100% pre-COVID, but also during the last 12 months, it did increase the loan and release new share and diluted shares. So that's why, even though it might still have room to grow, it's not as a good deal as 2 months ago. And there is some potential risk there to watch out for. And for Mesa, I think it still has potential and not overvalued, even after such a run up. If you want to re-enter again, I think 11 to 12 might not be a bad idea to open the position again, if you have the patience to wait for the consolidation. But today, I want to share with you 3 consumers/retail stocks that I think might be potentially good to watch out for, especially when the market does some correction after such a run up. Because right now, a lot of the capital are planning on their investment strategy, expecting a good recovery with the vaccine rolling out. But airlines or cruise lines are not the only choices we have, especially when most people are not so interested into the traditional industry, but more into the new and growth stocks. So today I want to share with you 3 stocks that I think would be considered growth stocks to begin with, but also can benefit from the recovery, unlike most of the tech stocks that benefit from the COVID. First of all, we need to look at what has changed. And second of all, what would people want to do? And third of all, who can benefit from it? First of all, what has changed is Americans are saving more during the pandemic. US savings hit record high because of the coronavirus. So it's because people have limited way of spending. That's why the saving household is hitting the record high. So it means that everybody in general has more saving and they need to spend it, which is what we call the revengeous spending after the pandemic, and also some kind of treat they want to give themselves with the extra saving than usual. So while everybody has piled up on the saving, what other things have they been increasing is also their weight. So pandemic weight gain is a thing. 61% of Americans say they gained weight during the pandemic. More than 2 in 5 adults packed on more pounds than they intended over the past year because of obviously lack of activities and much more of staying at home, being close to the fridge, working near the kitchen, etc. So that is another big change during the pandemic. And this article is about what Canadians want to do the most after the pandemic's over. And the number 1 on the list is actually doing regular things in the community without stress. So people miss having a normal life before pandemic. It's that simple. Something that we may have forgotten: physical contact, hugging people, shaking hands, etc. And then it's traveling internationally, dining in a restaurant, getting together with older people, traveling around Canada, going to concerts, going to gym and fitness classes, movie, theater, parties, and then sports event. What is the first thing you would do when pandemic ends? Hugs, kisses, and handshakes, gathering together, seeing family, getting out of the house, being a face in the crowd, and then traveling around the world. It is no wonder we see this chart. What are we looking forward to most after the pandemic? And the number 1 is a beauty therapy. I think a lot of people are getting anxiety over their own image or presentation during the pandemic because there's lack of beauty therapy, a proper haircut, and also the weight gain. So other than the makeup or cosmetic brands stocks like our stock YSG, the first stock I want to recommend that is a growth stocks and at the same time would benefit from the recovery is Lululemon, ticker symbol LULU. So on one side, when people are looking forward to the reopening and things going back to normal and we can see all our friends and family all over again, and with all the gathering and party, lots of fun. At the same time, people would also be worried about their presentation. So the more the vaccine is rolling out, the more anxiety people might have over their weight. Some people might feel they have urgency to lose their weight before things go back to normal. And I think that would benefit a sports brand. So Lululemon is a Canadian sportswear brand. It started with yoga wear and then spread it out to be more product lines and more men's products as well. It has a unique business model to be carried out by a lot of KOL and bloggers. The sales has been growing quite strong all these years. They have a good company balance sheet. The finance is running healthy. Even with the COVID, they were not under severe attack, but also took the opportunity to improve their e-commerce sales. And they have been fast growing into the 3rd largest sports brand after Nike and Adidas for sports fashion brand, and currently expanding overseas and have been doing quite well in their Chinese exposure, which to be one of the fastest growing market for them. I like the growth of this company because I think they can take this business model and expand further. Especially they have acquired recently an at-home live stream tech company called the Mirror with $500 million last July 2020. It is an American tech company, and their product is this mirror that can help significantly your fitness movements and also help you understand how you're performing, how much calorie you're burning, etc. I think this is a very good acquisition as it really balances out the product of Lululemon. And together they can complete a good home fitness scenario and can be a good competitor of another growth stocks, Peloton, ticker symbol PTON. During the pandemic, we saw it running from the low of $17 to the high of $171, so a 10x there. Currently, with a market cap of $35 billion, it's a great company with great potential because we know home fitness would be a massive potential market because it's quite convenient and capture a lot of people who would not like to go to the gym or it's not practical for them. Especially in the future, we would see more and more of a trend of working at home. So home fitness would likely not disappear after the pandemic's over. So I think for Lululemon to acquire Mirror, it's a good combination for them to develop more home fitness products and scenarios and compete with Peloton. Because I think right now with Peloton's market cap of $35 billion, it is actually making Lululemon's market cap of $40 billion look undervalued. Because even though they have been growing their e-commerce sales in 2020, their majority of the sales are still in the actual retail. So once the economy reopens, it would benefit more Lululemon, while at the same time they would benefit from the trend that would stay after the COVID. So that's why I would recommend Lululemon to be a stock that would benefit from the recovery and also at the same time a growth stocks. And number 2 stocks that I want to recommend has a lot to do with the saving that has been accumulated in every household. I think people would like to buy themselves and their families something that would usually consider a little bit expensive, but at the same time a good treat. And for this, I would have to go with Nintendo, ticker symbol NTDOY. So I think everybody knows who Nintendo is. I don't need to give you an introduction. And it has existed for decades and a very great company for the gaming industry. Their product, Nintendo Switch, had been very successful these recent years, popular among the youth and also families. So I think this would be a great treat for a lot of families to buy when they have accumulated so much extra saving, and possibly during the last holiday, the Christmas we had, the Black Friday event, they have probably been a popular item. So perhaps the next catalyst would be the earning. Second of all, this is also a game that includes a lot of social attributes. So when things go back to normal, a lot of people want to meet their friends and family and they can gather to play games again. So I think this is also one of the favorite activities to do with your friends. And the third reason is also because it is also a game you can do a lot of sports with, helping people lose some of the COVID weight. Another bonus point, it is also a game that involves some sports, dance, or just some movements. Can also help people lose some of the COVID weight. So I do think Nintendo would be a stock that can benefit from the recovery and the post-COVID effect. And at the same time, it is also a growth stock because I think right now they are at a turning point where they decided to make use of more of their IP, the characters like Super Mario, which they were not using or taking advantage as much before. And now they are also building a theme park called the Super Nintendo World. So I think they are kind of following the business model of Disney. And that might be potentially a very good turning point for the company. This is a stock I own personally as well. I bought it at around $65 in November. And right now it's sitting at the 70s. I still think it's an undervalued company given the legacy they have and the potential they can grow if they follow the business model of Disney. And if people have been getting more of their products during the last holiday, last season, we might see more institutions interested in it after the earning. So definitely you can watch out for this one, okay? And the third one would be Miniso, ticker symbol MNSO. So Miniso is a lifestyle brand from China. Their positioning is to offer affordable design, small items for home and small fashion. You might have run into it in a mall, a store that looks like Uniqlo, and you might have at some point thought it's a Japanese store, Japanese brand, but it's not. It's a Chinese brand made by a Chinese founder. But their positioning is more Japanese design with minimalist lifestyle, but much more affordable prices than Muji. Basically, if you run into the stores, it's very hard to get out empty-handed because you might end up grabbing some things that are cheap and good-looking impulsively, even though you did not plan to. So that's the business idea. And they have been expanding quite fast recent years, both in China and internationally. The founder has 2 successful businesses from scratch, and I've watched multiple interviews from him. I think he's a smart businessman with clear logic and business mind. His goal for Miniso is 百国千亿万店. It means he aims to reach 100 countries with 10,000 stores and 100 billion of revenue in 5 years. This would be very fast growth, but I think he might be able to do it. The business model for Miniso is very special. I don't want to spend too long here to explain it, but I think they can benefit from the recovery when more of the shopping malls are open because they're mostly located in the retail area, especially shopping centers. And I think even though they have e-commerce, they still get the majority of sales from the retail shopping. And with the pandemic being over, we can see more of their shops expanding internationally outside of China. Before the pandemic, their shops have been already growing well in Europe and a lot of countries in Asia. So when the economy reopened, I believe their growth would be faster, given a lot of people are quite eager to be back to normal, while they can enjoy going shopping in the mall during the weekend and after work. Shopping without a specific purpose. This kind of leisure shopping would be more of Miniso style. Recently, Miniso is also stepping into the trend of top toy like Pop Mart. Pop Mart is like the big trend that's going on with the millennials, and that might be a way for them to engage more of the youth and make their brand more attractive to the millennials. For me, I have been watching this stock for quite a while, since their IPO. It had also had a great run up, and now with the correction coming down hard to as low as 20, but also have been bouncing back quite strong. So last week I have shared on the Discord saying I have been watching out for Miniso and waiting for an entry. And Tuesday, during the live show I had, I said that it would get rejected by this 60-day moving average. So I would rather wait until it backtests the supports and then go in. Right now, it has been rejected by the 60-day moving average and backtesting the support of the 5-day moving average at $26. So if you want, I think right now it's okay to open a position and continue to add in the dip. Next support would be at around 23.8, and then the next is here at 22 if the market does more correction. So that's it for the 3 stocks I wanted to share for sector rotation to consumer and retail brands that I think would benefit from the recovery and at the same time to be growth stocks. I hope you can find the information helpful and help your portfolio to diversify from only being the tech companies. And if you have enjoyed this video, please give me a big like and write me a great comment, and I'll see you in my next video. That's it, guys. Hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.